Two guys, same age, same city, same $55,000 salary, same $50,000 in the bank. One buys a rental property, the other puts everything into index funds. 20 years later, one of them is genuinely wealthy. The other one is also genuinely wealthier, but took on 5 times the risk and spent. He worked twice as hard to get there and spent hundreds of weekends dealing with things he never planned for. Here is the problem with every real estate versus stocks debate you have ever watched. Someone always picks a winner before they run the numbers. The real estate guy says cash flow is king. The index fund guy says compounding is everything. Neither of them is lying. Both of them are leaving out the parts that make their argument look bad. This video does not pick a winner. What it does is run every number honestly. The ones people show you on thumbnails and the ones they bury in the footnotes. By the end of this, you will know exactly which investment actually came out ahead, why the answer is more complicated than either side admits, and what the math looks like for your actual situation. Before we get into the numbers, if you find this kind of honest breakdown useful, hit subscribe right now. This channel breaks down financial topics the way they should be broken down, completely, with real math, no agenda. Subscribe and turn on notifications so you never miss one. Jake and Marcus both have $50,000 saved. They are both 30 years old. Same city, same income, same financial starting point. The only variable is what they do with that $50,000. And Jake uses it as a 20% down payment on a $250,000 rental property. A solid 3-bedroom house in a decent neighborhood. The mortgage is a 30-year loan at 7% interest. His monthly payment comes to $1,330. He finds a tenant and locks in $1,800 per month in rent. On paper, that is $470 per month in cash flow before expenses. Jake feels like a genius. He tells his friends. He drives past the property on the way to work and thinks, I own that. Marcus takes the same $50,000 and puts it into a total stock market index fund. No leverage, no tenants, no keys, no story to tell at dinner. He sets up an automatic contribution of $300 per month and genuinely does not think about it again. When his coworkers ask what he is investing in, he says index funds. They nod politely and change the subject. Nobody is impressed. On day 1, Marcus has a brokerage account and a confirmation email. That is it. This is the first thing the real estate versus stocks debate almost never talks about. The psychological experience of these two investments could not be more different. Jake's investment is visible, tangible, and socially impressive. Marcus's investment is invisible, abstract, and boring. That difference in how it feels will influence every financial decision both of them make over the next 20 years. And feelings, as we will see, are expensive. For the first year, Jake is living the landlord dream. Rent hits his account on the first of every month. He is claiming mortgage interest and depreciation on his taxes. His equity is building with every mortgage payment. The neighborhood is appreciating. Everything about this investment feels real and smart and working exactly as advertised. Meanwhile, Marcus logs into his brokerage account once a quarter. Year 1, his $50,000 has grown to roughly $55,000. Year 2, maybe $61,000. It does not feel like anything is happening. Just a number on a screen that goes up a little, then down a little, then up a little more. Now let's run the actual numbers through year 3, because this is where the fantasy starts meeting the spreadsheet. Jake has collected $64,800 in rent over 3 years. His mortgage payments total $47,880. That leaves $16,920 in gross cash flow. That number looks great. That is the number on the thumbnail, the number your landlord friend quotes at the barbecue. Here is what comes out of that $16,920 before Jake actually keeps any of it. Property taxes, roughly $3,000 per year, so $9,000 over 3 years. Insurance, $1,500 per year, another $4,500. He replaced a water heater in year 2 for $1,200. A roof leak in year 3 cost $2,800. He had 1 month of vacancy between tenants, which meant $1,800 in lost rent, plus $600 to relist. Jake manages the property himself to save money, which means late-night phone calls, weekend showings, and coordinating repairs on his lunch break. He is not getting paid for any of that time. After every real cost over 3 years, Jake's actual net cash flow is somewhere between $2,000 and $4,000, not $16,920. $2,000 to $4,000 over 3 years on a $50,000 investment, and that does not include a single hour of his time. Marcus has put in $50,000 plus $10,800 in monthly contributions over those same 3 years. At roughly 10% average annual return, the historical average for total market index funds, his portfolio is sitting at approximately $76,000. 0 hours managing it, 0 phone calls, 0 emergencies. But here is what Marcus does not have that Jake does: leverage. Jake used $50,000 to control a $250,000 asset. After 3 years of appreciation at 3 to 4% annually, that property is now worth roughly $270,000 to $280,000. His equity has grown to approximately $55,000 to $65,000. That is real wealth, and a significant portion of it came from using the bank's money. That 5-to-1 leverage is the single most powerful advantage real estate has over stocks, and it is the reason this comparison is never as simple as it first appears. If this breakdown is already showing you things the typical real estate versus stocks video skips over, go ahead and give this video a like. It helps more people find this content, and it takes about 1 second. Back to the numbers. Now let's talk about the real estate costs that almost never make it into the analysis. Vacancy. The average rental property sits empty for roughly 1 month per year. That is a full mortgage payment with 0 income to cover it. Every time a tenant leaves, you are paying for cleaning, repairs, listing fees, and your own time. Maintenance and repairs. Budget 1 to 2% of the property's value per year. On a $250,000 house, that is $2,500 to $5,000 annually. Some years it is a $200 faucet fix. Other years it is a $7,000 HVAC replacement you cannot delay because it is August and your tenant is threatening to leave. Capital expenditures. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These are guaranteed future costs that come in chunks of $5,000 to $15,000. If you are not setting aside money every month to cover them, you are not running an investment. You are running on luck, and luck has a billing date. Property management. If Jake hires a manager, that is 8 to 10% of monthly rent gone immediately. Roughly $150 to $180 per month. If he manages it himself, he is working a part-time job he is not getting paid for. Bad tenants. A tenant who stops paying and knows the eviction process can cost you 3 to 6 months of lost rent plus legal fees. That single event can erase an entire year of profit. It happens to landlords at every experience level. None of these costs appear in the $470 per month cash flow number. All of them appear in the actual bank account. By year 5, Jake is deep in the reality of being a landlord. He is on his 3rd tenant. He has replaced the roof for $8,500, dealt with a plumbing emergency for $1,400, and had 1 month of vacancy. His actual cash-on-cash return after all real expenses is hovering around 3 to 5%. Not bad, but not the 15 to 20% he described to his friends. Marcus is still doing essentially nothing. His portfolio has grown to roughly $135,000 to $150,000 by year 7, including his $300 monthly contributions. He did not pick individual stocks. He did not time the market. He just did not touch it. The compound growth is starting to accelerate. The gains on his gains are now generating more new wealth each year than his original contributions ever did. By year 10, Jake's property is worth roughly $335,000 to $350,000. His remaining mortgage balance is approximately $166,000. That puts his equity at around $170,000 to $184,000. His total out-of-pocket beyond the original down payment over 10 years is somewhere between $20,000 and $40,000. Marcus's portfolio with consistent $300 monthly contributions is sitting at approximately $165,000 to $180,000. He put in $86,000 total. The rest is pure compound growth. 0 weekends fixing anything. At year 10, they are surprisingly close in total wealth. Jake might be slightly ahead thanks to leverage, but Jake also spent hundreds of hours managing his property, took on $200,000 in debt, and concentrated his entire investment in a single asset in a single zip code. Marcus diversified across thousands of companies and never lost a night of sleep over it. We are about to get to the year 20 numbers, and they are genuinely surprising, especially what happens when you change just one variable in Marcus's strategy. Make sure you are subscribed so you catch the follow-up video where we model exactly what happens when you combine both strategies. Hit subscribe now, and let's keep going. By year 20, Jake's property is worth roughly $450,000 to $500,000. His mortgage is either paid off or very close to it. His equity sits somewhere between $400,000 and $500,000. After 2 decades of maintenance, repairs, tenant turnover, taxes, and insurance, his total net profit from cash flow above what he spent is somewhere between $50,000 and $90,000. Marcus's portfolio at 10% average annual return with $300 monthly contributions has grown to approximately $420,000 to $460,000. Total contributions over 20 years, $122,000. The remaining $300,000 plus is pure compounding. No debt, no tenants, no 2 a.m. phone calls about a broken pipe. At year 20, they are in the same general range, somewhere between $400,000 and $500,000 each. But how they arrived there is completely different. Jake worked for his, Marcus waited for his. Now here is the part that changes the math more than anything else. If Marcus increased his monthly contribution by just $200, bringing it from $300 to $500 per month, his 20-year portfolio jumps to roughly $550,000 to $600,000. In the stock market, increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying a second property, taking on a second mortgage, and doubling your workload overnight. Now let's be equally honest about the index fund side, because if this video only covered the downsides of real estate, it would be doing exactly what every stock market influencer does. Volatility is real and brutal. In 2008, the total market dropped approximately 37%. In March 2020, it dropped 34% in a single month. That if Marcus had $150,000 in his portfolio and watched it fall to $95,000 in 4 weeks, that is gut-wrenching. And the data shows that most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the exact worst moment. The strategy works perfectly if you hold through everything. Most people do not hold through everything. There is no cash flow. Index funds do not send you a monthly check. On a total market fund, you are looking at roughly 1.5 to 2% yield. On $150,000, that is about $200 per month. That is not replacing anyone's income. There is no leverage. Marcus used $50,000 to control $50,000 in assets. Jake used $50,000 to control $250,000 in assets. That 5-to-1 leverage is the primary reason real estate creates more millionaires than the stock market in most wealth surveys. And there is no depreciation. Real estate investors can legally deduct the theoretical decline in their building's value from their taxable income even when the property is actually appreciating. That is a tax shelter stock investors simply do not have. If you are finding this more useful than the typical real estate versus stocks take, hit like on this video right now. It takes 1 second, and it helps the algorithm put this in front of people who need to see it. And subscribe if you have not already. Real estate wins clearly in specific situations. If you are in a market where monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. If you treat it as a real business, screening tenants carefully, budgeting for capital expenditures, building systems, the returns can exceed stocks. If you house hack, living in one unit and renting the others, you can reduce your own housing costs to near zero while building equity. And if you understand 1031 exchanges, which let you defer capital gains taxes by rolling profits into a new property, you can grow your portfolio in ways stock investors cannot replicate. Real estate is not a bad investment. It is a specific investment that works exceptionally well under specific conditions that most people never bother to verify before buying. So here is the honest answer. If you have local market knowledge, time to manage a property, the temperament for illiquidity and unexpected costs, and access to a market where the rent-to-price ratio supports real cash flow, real estate can build wealth in ways stocks cannot. If you want simplicity, diversification, liquidity, zero management time, and the ability to scale without adding complexity, index fund investing will build comparable or superior long-term wealth with a fraction of the stress. And if you can do both, owning property in a strong rental market while consistently investing in index funds, the math on that combination changes everything. That is the next video. But before you go anywhere, the most important question you can ask about any investment is not which one wins on average. It is this: did you include everything? Because the answer that includes everything is the only answer that actually matters. If this video gave you a clearer picture of how these two investments actually compare, not the thumbnail version, but the real version, please hit like before you go. It genuinely helps this content reach more people. Subscribe for weekly videos that break down financial topics completely, honestly, with real math and no agenda. And drop a comment below. Are you team real estate, team stocks, or are you doing both? I read every single one. See you in the next one.